of this year, silver tested an unbelievable, just a staggering $121 an ounce.
Yeah, which was just historic.
Right. And today, it's sitting at around $76.
Yep.
That is a massive multi-month price collapse. And yet, if you look closely at the institutional capital flows over, say, the last 2 weeks, the absolute smartest money on Wall Street is piling into silver faster than at any point in the last decade.
They're just aggressively buying the dip.
Exactly. Today is Saturday, May 23, 2026, and, well, the old rules of math, money, and global macroeconomics are completely breaking down.
Completely breaking down.
Welcome to the Deep Dive. I'm your host, and as always, I'm joined by our resident macro expert. We are taking a massive amount of recent market data, shifting geopolitical updates, and raw economic analysis to answer one specific question for you today.
Right, the big question.
How are the largest pools of capital maneuvering through a world that is fundamentally rewriting its own rulebook?
It's a profound realignment we're looking at here.
Yeah.
We are looking at a landscape where traditional correlations, assets that usually move together or strategies that have worked for 50 years, they're just fracturing. You literally cannot rely on historical precedent right now because the underlying architecture of the global economy is, well, it's in the middle of a massive hardware update.
Which means we need to look at the entire board. We can't just isolate one metric.
No, absolutely not.
So, here is the menu for today's deep dive. We're going to start with the mechanics of the artificial intelligence productivity boom and how it is actively neutralizing global geopolitical risk.
Which is a wild dynamic in itself.
It really is. From there, we'll map out the impossible situation facing the Federal Reserve right now as they try to manage an economy caught between an energy squeeze and an AI spending frenzy.
A total nightmare for them.
Yeah, a complete nightmare. Then we'll look at the radical structural pivot happening inside China's economy, a pivot that is confusing a lot of traditional analysts right now.
Oh, yeah. The data out of China is totally contradictory if you don't look under the hood.
Right. And finally, we are going to reconcile that massive drop in silver prices I mentioned at the top, unpack the historic collapse in the gold-to-silver ratio, and show you exactly where the smart money is establishing his beachhead.
It's going to be a heavy one.
Oh, it is. Okay, let's unpack this. Let's start with that fractured rulebook you mentioned, specifically the old trading adage, sell in May and go away.
Right, the classic sell in May.
The idea that liquidity just dries up in the summer, institutional desks skeletonize, and the market generally just drifts downward until the fall.
Yeah, everyone goes to the Hamptons.
Exactly. But the data we are looking at shows that anyone who blindly executed that strategy 3 weeks ago is sitting on massive underperformance.
Massive.
The strategy is just dead in 2026.
It's completely dead. The traditional sell in May thesis, it really relied on a lack of catalysts.
Right.
It assumed that without steady stream of winter and spring earnings or, major central bank moves, gravity would just naturally pull equity prices down.
Because there's no news to keep the momentum going.
Exactly. But that completely misreads the two distinct macroeconomic forces dominating the market right now. The first is the structural change in geopolitical risk, specifically the unwinding of the risk premium in the energy markets.
Right. Let's talk about the Middle East. We've seen steady progress in the back-channel U.S.-Iran talks over the last month or so.
Yeah, those talks have been flying under the radar a bit, but they are crucial.
And when you look at the crude futures market, you can actually see the algorithm-driven unwinding of that risk premium.
Yes.
A few months ago, buyers were essentially paying a $10 to $15 tax on every barrel of oil just to hedge against the possibility of a hard closure in the Strait of Hormuz.
That's a huge premium.
It is. But as those diplomatic talks progress, even marginally, that worst-case scenario gets priced out of the market.
And the mechanical effect of that is a reduction in input costs across the entire global supply chain.
Okay, break that down for us. Why does the broader market care so much about that specific risk premium easing?
Well, when the threat of an overnight energy shock dissipates, corporate treasuries don't have to hoard as much cash for emergency operational capital.
Oh.
Right. If you're a major logistics company and you're terrified diesel is going to spike 40% overnight because a tanker gets seized, you have to hold back millions in cash reserve.
You can't invest it. You have to sit on it.
Exactly. But when that risk cools down, they can deploy that capital elsewhere. They can buy back stock. They can invest in R&D. But, and this is crucial, the absence of a negative catalyst doesn't automatically create a raging bull market.
That's right. It just stops the bleeding.
Yeah. The real reason sell in May is failing is the permanent daily catalyst of the AI productivity cycle.
Yeah, let's get into this because this isn't the speculative froth of 2023 or 2024 where companies were just, you know, stapling the word AI to their press releases to get a stock bump.
Oh no, the AI washing era is over.
It's over. The Q1 earnings from the mega-cap tech sector show concrete structural margin expansion.
Yes, real dollars.
Real dollars. We are looking at enterprise-level implementation where AI is actively optimizing supply chains, completely bypassing traditional logistics friction.
Yeah.
It's like injecting a brand new vascular system into a patient. It just routes around the blocked arteries entirely.
That is a great way to put it. What's fascinating here is how undeniably clear that operational rewiring is on the balance sheets.
Yeah.
Mega cap companies are reporting staggering reductions in overhead. I mean, they are automating complex back-end compliance. They're dynamically pricing their inventory in real time based on predictive models, and they're running customer acquisition at a fraction of the historical cost.
It's real efficiency.
Pure efficiency. So investors are looking at the lingering geopolitical tensions on one screen, the supply chain stuff, the wars,
Right.
and then they're looking at the raw, undeniable free cash flow generation of these mega caps on the other screen.
And they are choosing to trade the math, not the headlines.
Exactly.
Look at the VIX. The volatility index, the market's fear gauge, has been stubbornly low throughout April and May.
It barely budged.
Right. The volatility index isn't registering panic because the sheer thrust of this AI-driven margin expansion is acting as a massive counterweight to global uncertainty. I kind of think of it like the global market is a tightrope walker,
Okay.
and they are carrying this heavy anvil, which is the supply chain and war risks.
Right.
But they're also wearing a jetpack, which is the AI productivity boom.
That's exactly what it is. When a company proves it can increase its operating margin by 400 basis points in a single quarter purely through back-end AI efficiencies, institutional capital isn't going to pull out just because the calendar says it's May.
No way. Capital is staying fully deployed.
Fully deployed. The productivity gains are simply too large to ignore. If you're a fund manager, sitting in cash while these companies compound their efficiencies means you are locking in relative losses. You literally can't afford to be on the sidelines.
But, and this is a massive but, that explosive growth in the tech sector is creating a massive secondary problem.
The blowback.
The blowback, yeah. Which brings us to the situation right here in the United States. We have this tension between the deflating energy risks globally and the insatiable demand for AI infrastructure domestically. And it is completely breaking the macroeconomic thermometer.
It really is. The U.S. economic data from the first quarter is just a masterclass in contradictory signals.
Let's lay out the numbers. We saw Q1 growth clock in at 2.0%.
Which is fine.
Yeah, that is a solid, respectable number indicating a fundamentally intact economy. It's not a recession.
Right, the growth is there.
But the inflation metrics are just brutal. April headline CPI jumped back up to 3.8%.
Yeah.
And more importantly, core PCE, which is the Fed's preferred gauge, it strips out food and energy and adjusts for how consumers substitute goods. Core PCE accelerated to 4.3%.
Ouch.
Ouch is right. For a Federal Reserve that has spent years trying to hammer inflation back down to that mythical 2% target, a 4.3% core PCE is a five-alarm fire.
It is the absolute worst-case scenario for the current Fed regime, primarily because of what is actually driving it.
Right.
The inflation we are seeing right now in 2026 is fundamentally different from the pandemic-era inflation we all remember.
It's not stimulus checks this time.
Exactly. It's not driven by people buying Pelotons with government cash. It is being driven by two specific compounding vectors. First, the residual bleed over from global energy costs, and second, the staggering capital expenditure required to build the physical architecture of the AI era.
Wait, hold on. Let me push back on that second point.
Sure.
Isn't the AI revolution supposed to make everything more efficient? Like we just said, it's lowering overhead.
Yeah.
So why on earth is it driving inflation up?
That is the ultimate paradox of 2026 right there.
Unpack that for us.
Okay, so the long-term promise of AI is deeply deflationary. You are totally right about that. Eventually, it will drive down the cost of producing almost everything.
Right.
But right now we are in the trench digging phase. To get to that beautiful deflationary future, every major corporation on Earth is trapped in a massive arms race to build out the physical compute infrastructure.
Ah, I see.
And that requires specialized semiconductors, advanced memory architectures, high-density server racks, and the massive, massive data centers to house all of them.
So it's a hardware bottleneck.
Exactly. The demand for advanced computational hardware has completely overwhelmed global fabrication capacity. When you have every single Fortune 500 company simultaneously trying to secure allocation for next generation chips, the pricing power of the semiconductor foundries becomes absolute.
They can charge whatever they want.
Exactly. The cost of raw compute has just skyrocketed.
And that hardware cost doesn't stay isolated in the tech sector, does it?
No, it bleeds into everything.
Right, because if a major cloud provider has to pay, say, triple for their server infrastructure, they aren't just going to eat that cost.
Never.
They pass that cost directly onto their enterprise customers through higher software as a service subscription fees.
Right.
And then the logistics company paying for that SaaS platform has to raise their shipping rates to maintain their own margins. It's like a cascading margin defense that infects the entire service economy.
Which perfectly illustrates why that core PCE number is accelerating to 4.3%. The Fed watches PCE so closely because it tracks exactly that kind of secondary ripple effect through the service sector.
Yeah.
And that tech-driven inflation is colliding with the pass-through effect of the energy markets.
Right, the other head of the inflation monster.
Exactly. While the extreme risk premium on crude might be easing a bit right now because of the Iran talks, the baseline cost of energy over the last 2 quarters has been high enough to permanently elevate operational costs.
We really see this in the freight data. When diesel stays elevated for 6 months straight, it's no longer just a temporary energy shock. Right?
No, it becomes structural.
Exactly. It becomes baked into the baseline cost of moving a physical good from a port to a warehouse. The manufacturer has to raise the wholesale price of the good. The retailer has to raise the sticker price. By the time it hits you, the consumer, that energy spike has morphed into structural core inflation.
So the Fed is completely trapped between these two forces. They are looking at an economy expanding at 2.0%, fueled by hundreds of billions in AI capital expenditure, while simultaneously generating 4.3% core inflation.
Which means the dream of rate cuts is dead.
Completely dead. The market consensus at the beginning of the year, the idea that we would see multiple rate cuts in 2026 is completely gone.
The policy rate is locked in the 3.50 to 3.75% range.
Locked tight.
And staying there is an incredibly delicate balancing act for them. The Fed is essentially using a blunt instrument, which is the cost of borrowing, to try and fix a highly specific dual-vector inflation problem.
That is the core dilemma right there. Raising rates further to try and crush that 4.3% PCE, it would require pushing borrowing costs so high that it would inevitably trigger a wave of corporate defaults.
Right. It would shatter that 2.0% growth.
Exactly, and throw the U.S. into a hard recession. They'd kill the economy to cure the inflation.
But if they cut rates...
If they cut rates, they inject massive liquidity into an ecosystem that is already scrambling for scarce AI hardware.
Right. A rate cut right now would be like pouring jet fuel on a forest fire.
Oh, absolutely.
Cheaper capital would just allow all these companies to bid even higher for those same limited semiconductor allocations, which would drive the hardware inflation even further out of control.
So their hands are completely tied. They are frozen.
They have to maintain this restrictive 3.5 to 3.75% altitude, bleeding out the excess demand slowly, month by month, and basically praying they don't accidentally stall the engine and crash the economy.
It is the elusive soft landing, and it's looking harder and harder to pull off.
Yeah.
And, while the U.S. is paralyzed by the inflationary exhaust of its own tech boom, the data shows China executing a macroeconomic pivot that is arguably the most significant structural shift of the decade.
Okay, let's shift gears and look at China. Because the narrative coming out of Beijing requires looking way past the headline numbers.
Oh, you have to dig deep.
Right. They reported a Q1 growth rate of 5.0%. And historically, 5% implies a roaring Chinese consumer, massive retail expansion, and a booming domestic property market.
That's what we're used to seeing.
Yeah. But the underlying metrics completely contradict that narrative this time around. Look at the data. March retail sales growth plummeted to just 1.7%.
It's a staggering drop. A 5.0% aggregate growth rate paired with only 1.7% retail sales growth exposes a massive asymmetry in their economy.
Right.
The domestic Chinese consumer is fundamentally paralyzed right now.
You know what it reminds me of? It reminds me of a massive, mature tech startup that suddenly realizes its core mass market product is failing.
Okay, I see where you're going with this.
Right. Instead of burning billions on marketing to force a dead product on consumers who clearly don't want it, the founders execute a hard pivot. They abandon the retail consumer entirely and reposition the entire company to serve specialized high-margin enterprise clients.
That is exactly what is happening.
Beijing is doing exactly that, but on a sovereign national scale. For 2 decades, the global market relied on a very specific reflex from China. Whatever retail slumped, Beijing would flood the zone with cash stimulus.
Right. They'd hypercharge the real estate sector, build a bunch of ghost cities, and artificially inflate domestic consumption.
Exactly. And the markets have spent the last 6 months aggressively pricing in the expectation of that traditional cash stimulus happening again.
Everyone was waiting for the money printer to turn on.
But the 2026 data confirms that the old playbook has been permanently incinerated. Beijing has accepted the death of the debt-fueled real estate model. They are flatly refusing to bail out the domestic consumer this time.
Which explains why their official 2026 growth target was quietly lowered to the 4.5 to 5.0% range.
Yeah, that flew under the radar for a lot of folks.
It did, but it's the lowest target they have set in 30 years. It is a deliberate, managed deceleration of their legacy economy to free up capital for their new objective. If we connect this to the bigger picture, they are taking all the liquidity that used to go into building empty high-rises, and they are funneling it directly into massive industrial subsidies for advanced manufacturing.
It's a complete 180. It is a total mobilization towards strategic dominance in next-generation supply chains.
The scale of the capital reallocation is just staggering.
Yeah.
They are intensely subsidizing domestic artificial intelligence development, electric vehicle manufacturing, massive expansions in green energy infrastructure like solar and wind, and what the state planners are now calling the low-altitude economy.
Okay, let's drill into that last one, the low-altitude economy, because I think it's a perfect encapsulation of this entire pivot.
It really is.
This isn't just about, consumer drones taking photos at a park.
No.
Beijing is deregulating sub-3,000-meter airspace and pouring state capital into heavy-lift drone logistics networks. They are quite literally replacing traditional road-based infrastructure spending with a hub-and-spoke aerial delivery grid.
And the macroeconomic efficiency of that move is brilliant.
How so?
Well, instead of stimulating the economy by paying people to pour concrete for new highways, which, provides a temporary GDP bump but leaves you with long-term debt and maintenance costs,
Right.
they are building a permanent, highly automated logistics layer in the sky. It drastically lowers the long-term cost of moving goods, it reduces their dependence on imported fossil fuels for ground transport, and it creates an entirely new domestic manufacturing sector for commercial aerospace components.
It's a structural upgrade, not just a stimulus band-aid.
Exactly.
They're building an economy designed to completely dominate the global export market for the technologies of the next 2 decades. If the Chinese consumer won't buy apartments, the Chinese state will ensure that the rest of the world is forced to buy Chinese solar panels, Chinese EV batteries, and Chinese logistics tech.
But, and here's the friction point, an export-driven pivot of that magnitude requires open global markets.
Right, you need buyers.
Yes. You cannot export your way out of a domestic slump if your primary buyers, mainly the U.S. and Europe, are actively taxing your goods at the border.
Which brings us to tariffs. And this is why the recent 90-day tariff ceasefire with the U.S. is the absolute linchpin of their entire Q1 performance.
The timing was impeccable.
The timing of that diplomatic pause was a massive structural advantage for Beijing.
It functioned as a pressure release valve for their manufacturing sector. Think about the mechanics of a tariff pause.
Yeah, walk us through it.
When the threat of imminent sweeping tariffs is temporarily paused, say, for 90 days, global importers don't just sit back and relax. They immediately engage in massive inventory front-loading.
Because they know the clock is ticking.
Exactly. U.S. and European distributors rush to order massive quantities of Chinese high-tech goods, pulling forward months of future demand into Q1 just to ensure the physical inventory was sitting safely in Western warehouses before the 90-day clock ran out and tariffs potentially snapped back into place.
So it created an artificial buying frenzy.
Yes. And the result is that massive 14% surge in Chinese exports we saw in the first quarter.
Wow.
That export surge is quite literally the only thing propping up the 5.0% headline GDP, and it's completely masking the devastating reality of that 1.7% retail sales figure.
So Beijing essentially bought themselves a 90-day window to flood the global zone with subsidized tech,
Right.
cementing their market share while the U.S. is totally distracted fighting its own domestic inflation battle.
That's the global chessboard right now. So we have these two massive, distinct economic engines operating on completely different frequencies. The U.S. is trapped in a high-rate holding pattern, pouring capital into the digital architecture of AI.
Right.
While China has basically abandoned its domestic consumer to become the physical manufacturer of the green transition and advanced logistics.
And those two massive structural shifts, they aren't just happening in a vacuum. They collide in the physical world.
They absolutely do.
They collide in the raw commodity markets.
Oh.
Which brings us back to the metals
Yeah.
and that massive data discrepancy I brought up at the very start of the deep dive today.
The silver collapse.
Right. In January, silver was trading at $121 an ounce. Today, it's sitting at $76.65. Gold hit $4,690 in January and is now sitting around $4,540.
So to understand the smart money positioning here, we have to separate the absolute price action of the metals from the relative performance between them.
Okay, let's break that down.
The massive drop in silver from 121 to 76, that was a macro-level liquidity event.
What did that mean in plain English?
So back in January, the market was still heavily pricing in the expectation of aggressive Federal Reserve rate cuts, right?
Because everyone thought the inflation fight was over.
Right. Speculative capital had flooded into the commodities market. Hedge funds were levering up bets on everything from copper to silver, assuming cheap money was just around the corner to keep the party going.
But then the data shifted.
Then the reality of that 4.3% core PCE hit. And the Fed signaled that rates were locked at 3.50 to 3.75% indefinitely.
And that speculative thesis just broke.
It broke completely. The cost of carrying those leveraged commodity positions became mathematically unviable with rates staying that high. So what we saw between January and May was a violent structural deleveraging.
People were forced to sell.
Hedge funds and institutional speculators were forced to liquidate their paper silver contracts, basically washing out all that speculative premium and driving the absolute price down to the mid-70s.
It was the financial equivalent of a controlled burn, clearing the deadwood out of a forest.
Exactly. The speculative froth is gone.
But underneath that absolute price collapse is a much more important metric that reveals exactly how the underlying fundamentals have shifted.
The ratio.
The ratio. Right after that U.S.-China tariff ceasefire was announced in early May, the gold-to-silver ratio violently collapsed from 62 down to 55 to 1 in just a single week.
That 7-point contraction in the ratio is, I'd argue, the most revealing data point in the entire market landscape right now.
Why is that?
It means that even though both metals came down from their January highs, silver is now aggressively accelerating against gold.
So what does this all mean? Because people usually think of gold and silver moving together like siblings.
Yeah, that's the traditional view.
If folks are scared, they buy both. So why are they suddenly diverging so violently?
And that divergence is happening because silver has a dual identity.
Okay.
While gold is almost entirely a monetary metal, it's driven by fear, central bank hoarding, currency debasement, whereas silver is highly schizophrenic. It is a monetary metal, yes, but it is also one of the most critical industrial components on Earth. It is incredibly conductive, highly reflective, and fundamentally irreplaceable in advanced electronics.
And what we are seeing in the data is the market actively stripping silver of its safe haven identity and starting to price it purely on its industrial fundamentals.
Exactly. Just look at the two macroeconomic engines we just detailed.
For U.S. and China.
Right. The U.S. mega-cap tech sector is spending hundreds of billions building AI data centers. The physical servers, the advanced memory architectures, the specialized switches required for those data centers, all of that requires physical silver.
It's heavily used in semiconductors and chip fabrication.
Yes. And at the exact same time, China's massive pivot toward advanced manufacturing relies entirely on green energy dominance. The subsidized explosion in solar panel production over there, it requires an astonishing amount of silver paste.
Right.
The electrification of their vehicle fleet requires miles of silver-laden circuitry.
So the industrial demand floor for silver is rising exponentially, driven by the two largest economies on Earth executing massive hardware upgrades simultaneously.
While simultaneously, the monetary drivers for gold are weakening.
Because of the geopolitical cooldown.
Exactly. As we discussed, the back-channel Iran talks have deflated the geopolitical risk premium. The tariff ceasefire temporarily cooled the threat of a global trade war.
The fear index is dropping.
Right, the VIX is low. Gold doesn't have the industrial tailwind to support its price when the geopolitical fear recedes. It relies on panic.
So the smart money is looking at a deflating gold price and an artificially suppressed silver price that just survived a massive speculative washout.
Yes. They recognize that at $76, silver is trading at a massive discount relative to its impending supply-demand deficit.
They see the physical shortage coming.
Absolutely. The ratio contraction from 62 to 55 is the mathematical footprint of institutional capital rotating out of the fear-based safety of gold and aggressively taking possession of the physical building blocks of the AI and green tech revolution.
It is a ruthless, highly calculated reallocation.
It's very ruthless.
The smart money is basically betting that the physical constraints of building the future will dictate asset prices far more than the traditional macroeconomic fear cycles of the past.
They are buying the infrastructure of tomorrow, not the fear of today.
Which allows us to pull all of this together. The entire board has shifted. The topography of the global economy is being actively rewritten right in front of us.
It's a completely new era.
So, synthesizing everything we've pulled from the sources today, what is the ultimate takeaway for you, the listener, trying to navigate this landscape? If you're looking at your own portfolio right now or trying to steer a business through this, what do you do?
Well, the prevailing theme across all the data is the obsolescence of binary thinking.
Explain that.
You simply cannot look at the market through the lens of simple growth versus value or risk on versus risk off anymore. Those old binaries will get you killed in this market. Think about it. The U.S. is fighting inflation not because the consumer is overly wealthy and spending recklessly, but because the corporate sector is frantically buying AI infrastructure.
Yeah.
China is growing at 5.0%, not by enriching its citizens and building houses, but by flooding the world with state-subsidized green technology.
The old correlations are just dead. The sources make it overwhelmingly clear that the only survival strategy in a transitional period of this magnitude is aggressive structural diversification.
And that diversification must be anchored by a relentless focus on the Federal Reserve's policy rate.
The 3.50 to 3.75% band.
Yes. That band is the gravitational center of the entire global financial system right now.
Because it dictates the cost of capital for the AI build-out in the U.S., right?
Yes. And it influences the strength of the dollar, which in turn dictates the pricing power of Chinese exports.
Right, and it entirely controls the liquidity available in the commodity markets like we saw with the silver washout.
Exactly. Every decision, every capital allocation you make must stress test against the possibility of the Fed being forced to hold that rate higher for much longer than anyone expects.
Because if the physical constraints of the AI build-out keep chip costs elevated and the pass-through inflation stays entrenched in the service sector, that rate isn't coming down anytime soon.
It's not. We are in a higher-for-longer regime driven by technological necessity.
Which leaves us with one final structural implication to consider before we wrap up.
And it's a big one.
It really is. Based on all the source material we've unpacked today, consider this. We're watching the U.S. trap itself in a high-interest rate environment simply because it cannot manufacture the physical infrastructure of the AI boom cheaply enough.
Right.
At the exact same time, we're watching China re-engineer its entire sovereign economy to dominate the manufacturing, export, and supply chains of that exact same high-tech hardware.
The collision course.
Exactly. We spent decades worrying about geographic choke points, like the Strait of Hormuz. But looking at this data, you've got to wonder, is the physical infrastructure of artificial intelligence, the actual fabrication of the chips, the copper, the silver, the energy grids, has that already become the ultimate geopolitical battleground of the 21st century?
It's a terrifying and fascinating thought. The map is no longer defined by where the oceans are.
No, it's defined by who controls the hardware of the future.
Absolutely.
Thank you for joining us on this deep dive. Keep questioning the consensus and keep analyzing the data. We'll be back soon with another stack of sources to explore. Until then, navigate safely.